Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I am your host for about the next 25 minutes here on Options Guide TV. Okay, so our bearish butterflies didn't pan out. We're not having the same type of luck that we were around earnings. So I'm going to go back to the well. We're going to look at a Broadcom butterfly today around their earnings report. And I'm going to point out a few things in the options chains that are interesting in AVGO. But before we get there, we can still make an adjustment to our long butterfly that we put up on Monday. So you don't learn a ton from winning trades all the time, but you can learn from losing trades, right? Winners, they go, the profitability goes up, you sell it, you close it, you get out. That's simple. But right now, it's a situation where it's actually okay to make this adjustment that we're going to look at today. So I'm going to spend a little bit of time. We looked at doing what I like to call an open wing butterfly to the downside on Monday, hoping that a little bit of the downside, well, I don't know. We're more neutral than anything, right? I think if you had your ruthers looking back over the last couple of months, you would be selling some premium. You'd be selling out of the money call spreads, selling out of the money put spreads, maybe even doing iron condors. Those would be the ideal scenario, just because the market just can't really get a hold on to where it wants to go to next. We're slowly drifting up. At this point in time, we're pushing up against that 6,000 level in the S&P 500 index. As a matter of fact, we're at 5,986 right now. We're up about 16 points on the day, or a third of 1%. But let's get to the adjustment on the trade before it goes away, because it moves fast in the S&P 500 index. You have to have a lot of premium in order to be able to adjust the trades. So we put together on Monday. Wednesday's a decent day to adjust. Thursday would even be better because you make the adjustment. You have a little bit less time left in the option contracts. And then on Friday, it's almost too late to make an adjustment. You're getting to a point where a lot of the time premium is drying up. But you really see in the SPX, the time premium start drying up at noon Eastern time. Going in the last 4 hours is a huge amount of time decay in the option contracts. So let's go back and look at our trade here, and let's get the setup. So let's run to the Tradier Pro software. All right, we can do it that way if you would like. And inside the software, I'm going to start by looking at the initial trade that we had on. So we did a long put butterfly on Friday. That trade didn't work out. I mean, you could close it for a dime, not worth mentioning at this point. This trade that we're looking at that we also put on Monday, kind of doubling down on the bearish outlook in the SPX, was a June 6th expiration, 0606. And the market was trading fairly close, right around 55,900 is about where the market was trading. We went out and bought the 5,895 strike call, sold two of the 5,880 strike calls, and then didn't go, then moved 10 points down and bought the 5,870 strike call. Now, what that does is, if you look at this profit and loss graph here, is it allows us to be profitable if the market blew through the strikes. Now, this is as of today's prices. And if we send this to the trade ticket, you'll see that at this point in time, we need to send this one to ticket. There it is. This entire trade is trading for about 80 cents. So 1 by 2 by 1, you could close it out for 80 cents. Now that's going to be tough. 920, 580. You paid $2.50 for the trade. And so you would be down, if you just closed it right now, 150, 170. You'd be down $1.70 or $170 per 1x2x1 butterfly. So now the adjustment to this trade, and I'm going to focus your attention right over here, is we have a fairly expensive option contract that's trading for $9.20. And then we have a less expensive option contract that's trading for $5.90. Here's what I'm going to propose is that we're going to flip the script on this. And instead of being bearish, we're going to go bullish and ride into the end of the week. And the way that we can make that adjustment is we sell this option contract and then buy this option contract. Now, adds a lot of risk, and you have to decide if the risk is worth the reward. It would ideally have been better to do this trade a little bit earlier in the day, but we tape Options Guide TV at 11 o'clock. But I want you to just understand what the actual adjustment is to the trade. So in this instance, what you would be doing is selling the most expensive option contract, the $58.95, and then buying an additional $58.70. Okay, so if you do that, you're going to be short two, pointing down here at the bottom of the screen, you're going to be short two of the 58.80s and long two of the 58.70s. Okay, that's 10 points wide. That's a $2,000 requirement. The market is on the way up, and the market would have to come more than one standard deviation move by Friday down to the 58.80 level for us to basically be in danger. If it starts coming down, the value would go up, so you'd have to kind of panic a little bit there. We don't want it to go below that strike, and we're not going to make another adjustment. So here's the trade that we would send, and I hope that this is trading for at least $3. It was higher earlier, once again, when we started the show, but it's now trading for $2.85 net credit. Okay, so here's the adjustment. I would want to do this when this was trading maybe closer to $4, which would have been earlier during the day. And you put it on, you put the entire gaggle of options on for $2.50. You do the adjustment. You bring in a net credit of, let's say, $4. That would leave you with $1.50 of potential profit, but you have added additional risk, quite a bit of additional risk by doing that roll. So you have to decide, and this is the way that I'd always set it up in my own account. If I'm trading this and I'm adjusting this, I got to say, what is the net credit I would be willing to receive? To start with, that net credit is probably $9, right? If you were to look at what this spread would be worth when you initially set up the trade. Now it's going to come down precipitously as the market goes up. So what is the credit you'd be willing to do this trade at? Would it be at $4? Would it be at $5? And that's when I make the adjustment on the trade. Right now, it's $2.85. If I did the adjustment right now, right, because you thought the market was going to continue on up, we'd only be up 30 cents, but we'd be adding a lot of risk to the trade. But we still would have the chance of being profitable. So you have to look at it, how you'd want to approach it. I would have adjusted it earlier, and even before the call, even an hour ago, this was trading for about $3.50, which means you would have brought in at least $1 to adjust the trade. But now you're looking at $2.75. Now, there's one other adjustment that we can look at too. So let's go back. Let's pull this up, and let's go back to the butterfly. These are at the actual prices when I put it in here. So those haven't moved. So right there, it's kind of showing the initial cost. Now, here's another smaller adjustment that's saying I'll be willing to take a little bit of a loss, but I want to try to salvage something off of the position. Now, remember, I can close everything for 80 cents. I can get out of this trade, and I put it on for $2.50. I could take it off for 80 cents. Or I could go and look at adjusting this trade where I sell the most expensive option contract and then buy back one of the short options. In that instance, you're bringing in about $2 or $2.10 if you're using these prices right here. I paid $2.50. Now I'm I'm basically rolling into the short put spread, bringing in a net credit of $2.10, but I paid $2.50. So I'd be down a little bit on the trade if I did this, but then my risk is only $1,000 from $58.80 down to $58.70. I would only have one short put spread on if I did it that way. So this is the adjustment. I do it 100% off of where the spread is at. If we paid $2.50 for the butterfly, if my price would have been somewhere around $4, I would have wanted to do the roll if I'm going to take on more of the risk. You could also make that same type of adjustment and say, I'm willing to accept less, but I'm going to reduce my risk by buying to close one of my short option contracts. Okay, so in this instance, here's the way it would look. If you did the adjustment, and I'm going to say the full-blown adjustment where you rolled and you created the different risk, is you go from this position to this position, right? So you sell the most expensive option contract and buy the least expensive option contract. You roll into two short put spreads. You would have this position on, and then it would look like this. Market's at here, 59.87. You would have to come all the way back to the 58.80 level, 58.80, which is right about here. And that's where your short strike would be at. So you have, 100 points, almost exactly, that the market would have to come back in order for this position to be at risk over the next 2 days. So you go from this and you make the adjustment and you end up with this. And that's where your risk is, or your trade is at. Okay, so here is the adjustment. It's 280 right now. I really want to bring in a lot more of a credit, but this is the way the adjustment would be. You have the butterfly position on, right? You're going to sell this option contract, the 58.95. That's the 6.4 butterfly. You're going to sell this option contract, the 58.95, and then you're going to buy the 58.70. And this is the way the trade would look. Bring in a net credit right now of 285, which is horrible relative. We looked a lot better in the morning, but $2.85. And then once you do that, you remove this option contract and add one here, and you end up in a short put vertical spread, and you would be in two of those. And that's where your position would be at. Okay. So if you have any questions, I see a comment. When you fill on an opening SPX butterfly trade, do you enter a to close order as soon as you get filled on the opening order? Yes. If I am doing that trade, the close order, Anthony, would be to close the butterfly if the market went down, and ideally you're looking to double, right? We paid $2.50 for it. If the market went down and I could sell it for $5, I would get out. So initially put on the butterfly, put in a limit order to sell to close the butterfly at $5. So I paid $2.50, would happy to take $5. If that doesn't happen, have an alert to say that if the trade comes down and that spread is trading, I'd probably say south of $5, the roll, then I want to know about it, and then I want to consider doing it somewhere between $4 and $5 to bring in a net credit to the account. And I do have additional risk, and I still have to manage it, but I'm not going to adjust it. And then if the market goes against me, the market comes down and goes against me, I'm going to just close out of the trade and manage it. I don't want to I don't want to lose the maximum on the short spread. If it ever came down to my short strike of my put, I would close it at that point in time for sure. And then you could also say to yourself that it's 10 points, it's 1,000 points per spread. If I have to pay half of that, if I got to pay $5 to get out of it, I'm going to do it too. So there's two different ways that I can approach it. But yes, always start by putting in a good till canceled. It's only going to be a week, but I'm usually looking to try to make $2 on the trade, or trying to double up on the trade. Paid $250, make $250. All right, let's look at Broadcom today. AVGO is the symbol, and I'm going to show you the change. And I've been struggling with this. This morning, I've been sitting here playing with this, trying to make the numbers work out. And I don't really like the way the skip strike butterfly should be a little bit more interesting than it is. Okay. And so I thought I would share that with you. Let's go and add this to the ticket, and I'll show you kind of what's going on in Broadcom. If you look at this position, Broadcom is announcing earnings after the close tomorrow. So the June 6th expiration is the 1 day or the 0 DTE option. So we have our scenario, or my scenario that I like a lot to look at skip strike butterflies, where a fairly pricey stock is announcing earnings on a Thursday when you have that Friday expiration. And $260, we got it trading at over 100% implied volatility. But if you look at the volatility skew and you start going up on the call side of things, you see that the implied volatility, and we're focusing just on this column, is increasing. And that's on the call side of things. So at a 1 standard deviation move, which is 20 points higher, 280 is the strike, we see the implied vol on the call option at 112. But as we go up, these are still real options. Even at the 305, now we're at 114, 310. We're still, 25-cent option contract. So it's not like it's going to zero yet, right? And we see that trading at 115, and then we even get all the way up to 117 on the 320. But then we start getting into worthless options at that point in time. So there's a skew of implied volatility, which doesn't usually exist on the call side of things, where people are willing to buy some of these. There's a lot of open interest in them. They're willing to pay up to buy the out of the money option contract. So in a way, you could say maybe that that's skewing to the positive side of things. You don't always know, right? Nobody necessarily knows if the earnings report's going to be good or not. But it seems like people want some of that upside volatility. They're willing to pay for it. Now, that is normal on the put side of things. On the put side of things, you usually will see a little bit of a skew as you go down in price. But I look at this on the call side, and this isn't a horrible skip strike butterfly, but this is the 20 cents is what we're looking, or what we're bringing in. It's not horrible. 280, 66, stocks at 260, up 325. You got 5 points wide there, and you're getting it done for a 20-cent net credit. And so you're looking to bring in $20 on 5 points of risk, and that's 4%. I'd like to get 10%, so I'd like to get 50 cents for it. Then I'm all over it. It's not horrible, but what's hurting us is that we got to pay up. We're paying that instead of usually paying less volatility for this way out of the money option contract that is more than a 1 standard deviation away, trading at about an 8 delta right here. We have to pay up for that. They're not going to give us that one for free. We're paying 80 cents for it, even though we're looking at the the Friday expiration. It's not a bad trade. It's not horrible, but I definitely would like to get a little bit more. I would like, even if we could get 40 cents for it, if we could double that net credit, that would be great. I'll make it the paper trade. We'll look at it. And, because you're looking at what happened with Broadcom and all this, what happened with NVIDIA. You saw a run up after earnings, and then it on the announcement, and then it backed off a little bit. And I think that you're going to have a lot of headwinds just in this space in general, and until we really get some solid news headlines. I kind of expect something like that to happen in Broadcom, but Broadcom's a little bit more volatile. Broadcom's average move, according to Earnings Whispers, is 10% after earnings. And right now, the implied move is about 8%. But the average move, according to Earnings Whispers, is 10%. Actually, 10.9, almost 11. Okay, so if you wanted to get bearish on the trade, you're going to have a similar situation. A lot of times, it's harder to get bearish with a skip strike butterfly because of the skew, because of what I was talking about. So let's look at that. Let's go one standard deviation move out of the way on the downside. We'll do 130, 78, 150. Okay. Let's do 137. 5 points would be 32. Hit that one twice. And then 27, 22. Buy that one. Yeah, it's not working out. So that's 5 points, and then that's 10 points. Yep. So we can't get it done for the net credit. So we're playing. So once again, 113 vol, we're skewing up to 114 vol here. Yeah, real tough to get this side done for a net credit also on the trade. The call side is the most interesting, I think, in my plans now. If you just want to get bullish on the underlying, I actually don't mind this trade either. I don't mind kind of skewing it a little bit to the upside. You're going to buy about $6 worth of intrinsic value and sell somewhere close to that too. So you're taking out implied volatility. You're giving yourself some upside. Your break even will be kind of medium on the trade. It'll be a little bit higher than the 260. So if I wanted to believe in the vol skew to the upside in Broadcom, let's look at buying. This is 530. This is 570. We're going to buy the 250 strike call. And then I want to be within a move that is achievable. We're still in the June expiration. You have 1 day for this spread to live, and you're just hoping that the market's saying that a 20-point move is feasible. Well, 18 points is feasible. 9 and 9. If we look at the bid to ask actually works too. About 18 points. And so from here, 275 is definitely within the range. That's 15 points away. 270 is 100% within the range, right? That's half of the expected move. And so I am buying, and I'm looking at the intrinsic value, 575 here. And I'm going to sell something that's a little bit higher right here. Let's hit about the same amount of time premium. And this has something to do with the skew. Okay. So 825 is the midpoint on this. And so that means that our break even on the trade is going to be very, very close. Actually, you're selling a little less. Okay, so 252.50 plus 8.25 means you're 252.5 plus 8.25 puts us at 260.75. So if the market just stays where it's at, we're at break even. We give ourselves some upside. We're basically got a 50-50 trade. We got a little bit better upside than we do downside. So we are 18 points wide, and we're paying 825 for it. So 18 divided by 8.25, you got a 2-to-1 risk reward. 2.18 is the risk reward. So you're making, for every dollar that you're risking, you would make $1.18 potentially if the market could move in this direction. You obviously have the risk to the downside. You're paying some real money for this trade, but you're okay if the market stays where it's at, drifts higher. If it goes lower, it hurts. And if it goes below 52.50, it really hurts. Okay. So you got to be bullish on the stock if you like that. So we're going to send this to the what if calculator. But here's what the general rule is, especially if you got a skewing to the upside, right? So you can get a favorable risk reward in this scenario by the fact that you're getting over 2-to-1, right? You're risking $8 to make 18, 8.25 to make 18, and or to sell this thing for 18, not to make 18. And with that said, here is your strike here. Here's the one that you're selling, 825 on a, let's go 270 minus 250, 1750 minus, so 1750 is the width between the strikes, minus 8.25 is $9.25. So you're risking $8.25 to try to make $9.25. Now, based off of the expected move, one of these are probably going to happen, right? Either we're going to go up approximately 20 points or we're going to go down approximately 20 points. It's very possible that they announce earnings and it stays where it's at. But this is a trade to say, I want to take the implied volatility out of the picture. I want to buy about the same amount of time premium as I'm selling. As a matter of fact, we got it because of the skewing and volatility. We have a favorable volatility or time premium situation. We're paying a very little time premium overall on the entire trade. And it's just all about the price. It's all about do you think Broadcom's earnings are going to be perceived as good or bad? And it's that straightforward. So when you see a little bit of a skewing to the upside like this is a type of trade that I don't mind doing at all. 50-50 trade across the board, and then get a little bit more upside. And you're going to find out in a hurry. So at the end of the close tomorrow, the time premium that you're selling on this option contract, which is $5.20, right, to 270. If it doesn't get there, that's got to go away. That goes from 520 to 0, right? Probably by noon, if it doesn't get up to that price. So if it does, that time premium also goes away, and it becomes all intrinsic value through the options contract. All right, I like this one too. So let's make the official paper trades that we'll look at is we'll grab this one, this Broadcom trade, and then we'll also look at the long butterfly. And let's send this one the ticket, see if it's still 20 cents. Yep, still 20 cents. It's not horrible. Like I said, I'd like it to be 40, but 20 cents isn't bad. You got $5 worth of risk. You could potentially make 20 cents if the market stays where it's at, goes south, or if it creeps up towards the 285 level, we're okay. Maximum risk. The worst thing that you can have happen on the skip strike butterfly is that it gaps open more than the expected move on the open. And there's only one scenario that really, really hurts you bad, and that's that scenario because you don't have time to trade out of it. Any questions? All right, I think that's it. We're right at time. So that's it for this edition of Options Guy TV. We'll come back on Monday and look at the Broadcom trade. Well, on Friday, we actually, I'll probably be traveling this Friday. So I'm going to have an education piece that's going to be out there. But you can look at the Broadcom trade, see where we turn out, and then I'll be back on Monday for a next live edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.